I would now like to go over problem 18-3, and it pertains to a company reacquiring their own stock. Why would a company reacquire their own stock? By reacquiring their own stock, they're reducing the number of shares outstanding. Why would they want to reduce the number of shares outstanding? One reason is to offset stock options and employee purchase stock in the current or upcoming year. Another reason is the company may feel that their stock is undervalued, so by repurchasing their own shares, they hope to increase the price of the stock. Another reason would be they are planning for a merger, so they want to reacquire some of their shares. Now, there are two ways to record this. There's the actual retirement of the stock method or the treasury stock method. I will go over each method separately and explain the journal entries as we go through this problem. First, I'd like to read the problem. It's National Supply shareholders' equity included the following accounts on December 31st. So they are giving our shareholders' equity section the common stock $6 million, at par is $6 million. The paid-in capital in excess of par is $30 million, and retained earnings is $86,500. National Supply reacquired shares of common stock in two separate transactions and later sold stock. Prepare the entries for the retirement of the stock and the treasury stock. First, I would like to go through the retirement of the stock. On February 15th, 2021, they reacquired 300 shares at $8 per share. So before we can even start, we have to compare what they're paying to reacquire the shares, and they're paying $8, but how is it recorded in their stockholders' equity? Well, if you take 6 million divided plus 30 million is $36 million, and divide that by the shares outstanding of $6 million, the original purchase price received by National Supply shareholders for common stock was $6. So on February 14th, 2021, they reacquired 300 shares at $8 per share. So what we want to first do is reduce the common stock and paid-in capital in excess of par based on the original purchase price of the stock, which is $6. So we have to split that between par value and paid-in capital in excess of par. I told you the total amount was $6. The 36 million divided by 6 million is $6. So we would debit common stock for 300,000 shares, which the company is repurchasing at $1 par, which is $300,000. We're then going to debit the paid-in capital in excess of par for $5, which is the original selling price of the stock recorded in the stockholders' equity section of the balance sheet of $6 minus the par value, is 1. So there's $5 of excess par that we have to remove, which is $1.5 million. The company then credited cash for $300,000 times 8, which they paid for the stock, which is $2,400,000. The difference is a debit to retained earnings for $600,000 to balance the equation. So when you look at this journal entry, we have removed the common stock the company is repurchasing. We remove the paid-in capital based on what the company is repurchasing at its original selling price. And that was $6, but they paid $8 more. Now, there is a debit to retained earnings when the company actually pays more for their repurchase of stock than they originally sold the stock. So there would be a debit to retained earnings of $600,000. We're now going to look at the transaction for retired stock on February 17, 2022. They have reacquired 300,000 shares at $5.50 per share. Well, we know from February 15th purchases that the amount of stock that must be removed from the equity section of the company's balance sheet for the repurchase, the original selling price of the stock was $6. So we're going to take the common stock, 300,000 at par for $300,000, paid in capital in excess of par, which is 300,000 shares times 5, which is the 6 minus the 1, for $1.5 million. The cash is credited for $300,000 times $5.50 for $1,650,000. Now, in this case, we have the opposite scenario. The company repurchased their shares of stock at $5.50, a lower amount than they actually were originally sold for at $6. The difference appears in paid in capital shares repurchased, which is $150,000. So it's very important that you compare the company's repurchase price to the original sales price. And as you can see in the first journal entry, February 15th, they paid more for the shares to reacquire their shares than they actually received when the shares were sold. That resulted in a debit to retained earnings. Now, when the actual purchase price of the shares on February 17th is $5.50, it's less than the original purchase price, and the difference would be put into or credited to paid in capital shares repurchased. So it's very important you logically remember how the journal entries are recorded. My first journal entry I would do is I would credit cash for the actual price the company is paying to repurchase their stock. Then I would remove the common stock at par and the paid in capital in excess of par for the original cost of the shares they are repurchasing. For the November 9th, 2023 transaction, the company sold 200,000 shares at $7 per share using the FIFO method. So the company is selling the shares they previously retired. So the easiest journal entry would be to debit cash for what the selling price is, and it would be 200,000 times $7 is $1.4 million. Now, they're going to credit common stock for $200,000 times $1 par, which is $200,000, and they're going to credit paid in capital in excess of par of $1.2 million. Now I'd like to look at requirement 2 just for the retirement of the stock using the retirement method of the stock as opposed to the treasury stock method. Prepare a shareholders' equity section of the National Supply Company on December 23, assuming the shares are retired. Net income for 21 was $14 million, 22 was $15 million, and 23 was $16 million. So the first thing I would look at is I would go to the top and see what was my retained earnings at the end of December 31st, 2020. Well, my retained earnings on December 31st, 2020 is $86,500,000. So when I look at the retained earnings, this is the beginning balance of 2021. This is $14 million is the income from 2021. $15 million is the income from 2022. And in 2023, the income was $16 million. Then I would review the 3 journal entries for the retirement of the stock, and I can see on February 15th, the retained earnings account was debited for $600,000. There was no change in retained earnings as the result of the transaction using the retirement method. So I don't have to post any amount to the retained earnings account for the 2022 journal entry. And in the 2023 journal entry, there is no retained earnings recognized in that journal entry. So the retained earnings for the retirement method is $130,900 million. So I would put that in the retained earnings under the shares retired of $130,900 million. Now we have to go through and look at the common stock. What were the transactions in the 3 journal entries in 2021, 2022, and 2023? We can see that common stock was debited for $300,000 in 2021. In 2022, there was a debit of $300,000. And in 2023, there was a credit to common stock for $200,000. The beginning balance is $6 million. The debits to common stock when the company reacquired their shares in 2021 was $300,000 based on the journal entries. 2022, there was another $300,000 debit to common stock. And in 2023, they resold some of their reacquired stock, and that was a credit of $200,000. So the actual balance of common stock in the shares retirement account would be $5.6 million. The next account we're going to look at is paid-in capital in excess of par. We know from the beginning of 2021, the beginning balance was given to us at $30,000. For the transactions in 2021 and 2022, the retirement of the stock, the actual paid-in capital was debited for $1.5 million. And in 2023, paid-in capital was increased by $1.2 million. So we have the 2021 $1.5 million decrease in paid-in capital, 2022 a decrease of $1.5 million in paid-in capital, and in 2023 we have a debit of $1.2 million, which is $28,200. The last is the paid-in capital shares repurchased, and we have shares repurchased recorded at $150,000 in 2020. So the actual paid-in capital shares repurchase would be $150,000, and the actual paid-in capital in excess of par, we can't forget the 2023, which is $200,000, so that is 5.6. I'm sorry,